Hello, I'm Kent Kramer, Chief Investment Officer at Foster Group, and this is our regular collection of financial perspectives for the week ended Friday, August 7th. Historically challenging times like this can be hard for investors to navigate on their own, so we want you to know that we're here to help. We have over 1,400 clients who we truly care for, and it's our pleasure to help with all aspects of their financial planning, how people plan, invest, protect, and give, especially on uncertain times like these. The uncertainty in today's world can start to feel just a little overwhelming, we know. Sometimes it can be helpful to have a conversation with someone just to get a second opinion, to take a look and making sure that the things that you think are in place actually are, and that they make sense for where you want to go in the future. We'd be glad to have that conversation with you. And at the end of this presentation, we'll give you some contact information on how you can make that happen if you're not already a client of Foster Group. So last week ended with some political deadlock in Washington, D.C. over the next round of stimulus. Congress couldn't agree on a package. President Trump tried over the weekend for an executive order to kind of move in as a stopgap, especially as it relates to unemployment benefits, the extended unemployment benefits, which ended at the end of July. He proposed an additional $400 a week to continue, $300 from the federal government, $100 from states. At the same time, the unemployment rate fell last week to 10.2%, down from its high of 15% in April. The economy created 1.8 million jobs in July. The U.S. labor market still has 13 million fewer jobs than we had in February of 2020, but we have recovered about 45% of the jobs that were lost initially due to the pandemic. You can see how that job loss and then recreation has kind of taken effect here. The largest losses and kind of the area of the economy that has the most yet to go in terms of regaining jobs is that area of leisure and hospitality. Think about the travel industry, hotels, even things like restaurants. They just have a long way to go before they're back to full strength where they're operating in February. Probably the single most influential thing for the economy, however, in our markets' day-to-day life experience is progress on controlling and ultimately defeating COVID-19. Like other things, reports are really mixed, with outbreaks popping up in locations around the US and the globe, while vaccine and treatment development progress at a historically unprecedented pace. The US has over 5 million diagnosed cases so far. About 1 million of those new cases were diagnosed in the last 2.5 weeks. You can see that in states like Florida and Arizona, things are getting better. Things haven't quite peaked yet in Texas, and there are other hotspots around the country. Vaccine progress really continues around the globe, and as we'll see here in a minute, there's hope for first implementations in late 2020. The array of vaccines and progress reports can be hard to summarize, but this graphic from Bloomberg Intelligence shows the possibility of some approved vaccines in the fourth quarter of 2020. You can see that phase 2 and phase 3 trials are well underway, and those green arrows and bars that look in that kind of Q4 slot there, those are the places where it's very possible or likely that some implementation of approved virus vaccines could begin to hit the market around the world. So that's, I think, some truly good news. Just seeing the numbers of companies that are developing vaccines, I think, should be encouraging, as they're all progressing through different phases of their trials. In terms of market news, there are some conflicting signals in the numbers over the last couple of weeks, especially if you think about things in terms of conventional wisdom. Global stock markets were positive for the 2 weeks just ended. They were led by small companies, gold prices, and technology. Interest rates drifted slightly lower, with the 10-year Treasury bond falling from 0.612 to 0.568. Normally, when gold is rising, there's pessimism in the air, which means that stock markets tend to be declining. But last week, we saw both heading in an upward direction, and you can see that on this chart right here. Small company stocks actually had their best week since June, but you can also see that the NASDAQ 100, that NDX, continued to do well, as did gold, the red bar there. So we'll talk about gold here in just a second. Investors can be forgiven if they're confused about what markets are indicating about the future. I mean, daily news statistics seem to paint almost opposing views. The stock market and some labor indicators seem to show things getting better, while interest rates, persistent struggles with reopening due to the virus, and gold prices seem to say there's a sentiment that things are going to get worse. So which is it? The likely answer is that no one really knows for sure. As we've said at Foster Group for many years and continue to say, investors seem to do better when they embrace uncertainty, We understand that the world is very unpredictable, so confusing symptoms, while confusing, really aren't surprising. However, because gold is getting a lot of attention right now, let's take a little closer look at the yellow metal. Why gold? Well, gold traditionally trades at higher prices in times of pessimism. Some investors think of it as a hedge against currency devaluation or inflation or stock market declines. Its tangible nature makes it seem more solid than simply shares in a company, stock market certificates, or shares on our balance sheet somewhere that we really can't touch or see. Others see low interest rates and they see no reason to hold bonds or cash right now because their safe investment is paying them nothing. So why not hold gold as their safe investment instead? Gold is basically a speculative asset. It's hard to make an economic case for it other than people just seem to value it. It pays no interest, it produces no product or services, so it's not profitable in a historic economic sense. However, some people do think of it as a universal currency or store of value that might survive in certain economic conditions, particularly under duress. Again, one of those things might be decline of the dollar. The dollar has weakened recently, actually to its lowest level since June of 2018. However, the dollar is still the reserve currency of the world, and we still issue 100% of our treasury debt in dollars, meaning that investors, both individuals and countries who loan money to the United States, will be repaid in dollars, whether those dollars are strong or weak. Another thing, if we look at the dollar over a little longer period of time, we can see that the dollar value today is really not particularly high or low. It's been higher and lower in the last 20 years. It's still actually above median for the time period. While the US has spent a lot of money in the current crisis, the rest of the world has spent that kind of money as well. Governments have all increased their debt. Currency strength, remember, is relative to another country's currency. One positive for US investors in foreign stocks is that when our currency declines a little bit, that tends to enhance the returns from global diversification as the dollar weakens relative, let's say, the euro or the Japanese yen. In general, over the very long term, going back to 1947 or just post-World War II, owning companies, in this case represented by the S&P 500, has been a much more rewarding overall investment, significantly outpacing inflation and the return of gold. The combination of dividends and productivity growth has been significant, as we can see in this chart. If we look at the period starting in 2004, and we talk about gold as maybe an inflation hedge, something that's correlated with movements in the rate of inflation, which is that blue line on the bottom, the statistics would say gold is really not that correlated. If something is correlated, you expect it to go up when inflation goes up, and it could go down when inflation goes down. Gold moves really to its own rhythm there. It's not necessarily tied to inflation anyway. I included on this chart ETF with the symbol TIP, TIP. That ETF invests in US government Treasury inflation protected bonds. Those Treasury inflation protected bonds or securities, they track inflation very well. If an investor wants to have a hedge against unexpected inflation, a TIP is a much better hedge because it adjusts with inflation every single quarter. One thing, you look at this chart and you'll see that since 2004, gold has done relatively well as an investment. It peaked in value in 2011, kind of went into a decline, and then has peaked again recently. It did very well while the US stock market did not do particularly well in the early 2000s. Again, if we look at the last 10 years, though, we'll see the US stock market, as represented by the red line here, the S&P 500, has done particularly well. Gold prices peaked September of 2011, just below $2,000 an ounce, 1,900 some an ounce, and then went into a decline for the next 10 years before coming back up here most recently. I think the question people are asking is gold prices rising indicating something really troublesome yet over the horizon, or are gold prices just reacting a little bit late? In other words, are people piling into a trade because they're trying to hedge against the possibility of something negative happening in the future? The thing to remember with gold is it has been a negative returning asset at least since 2011. It doesn't tend to track inflation very well. However, gold does tend to be a historically interesting asset. There have been times when it's done quite well. It's just hard to tell when it's going to do well again. The reason gold is an interesting asset is it's hard to understand. At Foster Group, we like diversification as much as anyone. We just like to understand the economic rationale for every investment that we have in a portfolio, either due to its production of income through dividends or interest, whether it's a productive asset like a company who sees the share value increase in price because the company becomes increasingly productive over time, or maybe a commodity that actually is subject to industrial or consumer demand, causing the price of that commodity to rise for some productive purpose. Gold doesn't really seem to fit any of those categories. It continues to be an interesting one. People like to speculate on it. But from our point of view, if it's going to be in your portfolio, it would be a very small section and it would be purely a speculative asset. As always, thank you for listening in today. If you have any questions or would like to meet with a Foster Group advisor, please contact us at your convenience. You'll see a lot of different ways to do that on this slide. Our team's fully engaged every day. Technology allows for face-to-face conversations as well as accessing our investment financial planning tools. And if you're finding these presentations helpful, please share them with your friends and colleagues. Thanks for watching. We hope to see you in a couple weeks.